Good evening and welcome. You are ready to take a seat and start learning about our comprehensive annual financial report. My name is Yvette. I want to welcome you to this workshop. This is actually a pretty good turnout for us for our very first workshop. We have a few more planned, so we hope that you are a recurring guest for these workshops. We hope to include more, and before the evening's up, we'll send around a survey for you so you can give us some feedback on this workshop and what you'd like to see in the future. But before we get started, I wanted to ask a couple of questions. So I've been a teacher in the past, so I tend to try to get you all involved, but I won't call on anyone specifically. But I did want to ask, well, first of all, I wanted to introduce our council members who are here tonight. We have our Mayor Pro Tem, Janice Elliott. We have Councilmember Rudy Zuniga. Councilmember Bill Elliott. Bill Bojo. Sorry, no relation. Sorry about that. I was already moving ahead. My apologies.
You don't want to give him my last name.
And we have our speaker here tonight, who I'll introduce in just a moment. We also have our city's finance officer, Londa Bosch-Helms, in the back. So, and we also have our analyst for public works, who's brought all kinds of, Michelle has brought all kinds of flyers about upcoming public works workshops and opportunities for water conservation opportunities for you. So there's all kinds of flyers back there. We also have some goodies, so make yourself comfortable. For those of you who haven't been in this building before, we do have restrooms. If you need to use them, please feel free. They're right outside and to your right when you exit the doorway right here. Okay, so let me ask you, what are you hoping to learn tonight? What do you want to take away from this workshop?
How to read this.
That's good. That's a good start.
Clear financial condition of the city.
A clearer financial condition of the city. Okay.
It'd be kind of nice to know how, compared to a regular balance sheet or profit and loss, like a regular business has, how is the city kind of different?
Okay. Anybody else? Anything specific you're hoping to find? Well, our goal is to teach you about how to find the information that you need to find in the document, for you to understand what drives what's in the document and how it's assembled and what information that you can find in the document. Our speaker tonight will not be giving opinion on whether the city's doing something right or wrong, but it's really about how to read the document so you can determine that for yourself. So hopefully you'll find this beneficial. So I'd like to introduce our speaker tonight. Brett Van Lant is a partner in Van Lant and Finkenau, and they have audited the city for the first time this year. We went out to bid, and our goal was to find the strongest auditor that we could find who would keep us accountable and who would maybe give us suggestions of how we can do things better, but also to really scrutinize our books. And I will tell you that they were really thorough. They were paid a lot of attention to detail. And I know that our staff spent a lot of time gathering information for them as well. So they were well worth what we paid them to do. I know it was a big undertaking to take over a new city this year, especially one with some complicated history. So with that, I'm going to turn it over to Brett, and he's going to take it from here.
All right. Good evening, everybody. My name is Brett Van Lant. I'm a partner with Van Lant and Finkenau. The city management has asked me to kind of give a brief overview of the CAFR and kind of talk about the information, how it's derived and how it ends up in the CAFR. I would kind of just try to keep it very informal. If you guys have questions as I go, stop me. I'll try to answer them as best I can. Kind of my first time doing a big workshop, so bear with me as I go through it. So we'll start out just kind of going through what is a CAFR. Obviously, it's a comprehensive annual financial report. It includes the management's discussion and analysis, which is the MD&A, the audit report, the basic financial statements. It has required supplementary information and also the supplementary information. And there are other parts to this CAFR that might be useful to some, the statistical section, things like that. But I'm going to kind of focus on these ones because these are the kind of the guts of the financial statements that have the most meaning. And again, all of this is coming from an auditor's perspective, so just keep that in mind. Who are the users of the CAFR? Who actually takes this information and uses it to make decisions or decide whether they're going to invest in the city or things like that? And so the users of the CAFR, management, city council, the citizens, residents of the city, bondholders, employees and retirees, grantors, they are actually using your CAFR to make decisions, review it, have questions, things like that. So these are the users of your financial statements. And when I say CAFR, you can interchange it with audited financial statements. That's kind of the main thing that a CAFR actually is. When is the CAFR prepared? The city's fiscal year end is June 30. And so typically within a 6-month period is when a majority of financial statements are issued. It doesn't always work out that way. Sometimes it's January, sometimes it's February, sometimes it's March. I have had some clients where it's all the way till October of the following year. So those aren't the best finance departments, but when it goes that long, but it does happen. There's a lot of information that goes into the financial statement, and for an auditor to actually sign off and issue an audit opinion, it's all got to be in there, or we won't sign off on it. So where does the information in the CAFR come from? Well, a majority of it all comes from the city's accounting records, which is the general ledger. That's the accumulation of all the activity that takes place throughout the year, all the checks that are issued, all the payments that are received, all the balances for cash and receivables, things like that. That's all accounted for on a daily basis, and then monthly basis, and also on an annual basis for certain balances. So that's where a majority of the information comes from for the actual financial statements themselves. Some of the information for bonds obviously comes from the actual bond documents themselves. Your municipal code regarding some of the note disclosures in your financial statements. Resolutions adopted by City Council that talks about some of the different disclosures in your financial statements as well. Capital asset schedules that Finance Department maintains, and also actuaries, CAFRs, and then hired actuaries for your post-employment benefits, the net OPEB liabilities, things like that. That's coming from actuaries. So why do you need a CAFR? Well, it's intended for the users of your financial statements, and it's also required if you have federal expenditures that exceed $750,000, or if you have municipal bond debt, and also it's typically required by your own ordinances. So there are government agencies that may not be required if they don't have any of these requirements to actually have a financial statement. So we'll talk about kind of the formatting of your financial statements and where that information comes from in order to actually present it the way it's presented, or it was just your...
What is OPEB?
I'm sorry, it's other post-employment benefits, which for the city is basically the benefits that have been promised for retirees for health insurance. That's the biggest one, and it's a liability for the current retirees and also employees that have accrued or are estimated to get a benefit. So that's what the OPEB is. GFOA, which is the Government Finance Officers Association, they're the ones that the city would be sending this financial statement to receive the award for excellence in financial reporting. I know they've received it for, I don't know the history on it, but I know it's been many, many years that they've received the award for submitting for the CAFR. So the GFOA is also a good resource for providing best practices for governmental accounting and also for financial reporting. And so it's also a resource that the city uses, and us as auditors, we use it regularly. In addition to the GASB statements. I'm not a walking encyclopedia, but having access to GASB statements to make sure that every year that your financial statements are following the proper standards for financial reporting. So earlier we kind of mentioned the management's discussion and analysis, and that begins on, I believe, page 4 of the CAFR itself. And this is a part of what's called required supplementary information. It's required as a part of to supplement the basic financial statements. And the information in your management discussion and analysis is all required information by the accounting standards. Probably one of the most useful areas for readers to, when they're looking at your financial statements, it's not a comparative financial statement when you get to the basic financial statements. You might not know, well, our revenues are 40 million, is that good? Well, what were they last year? Did they go up? Did they go down? Are we moving in the right direction? So this is kind of a good starting point to kind of see, well, did our fund balance increase or did our fund balance decrease? Did our expenditures go up? Did they go down? This is kind of where you would start to start analyzing your financial statements. Again, the MD&A is focusing on the governmental activities, the business type activities, and major funds. And I'll kind of get into major funds in just a minute. But so it's going to focus kind of on a summary level, the main funds of your financial statements, and not all the smaller funds that are in the back. So sorry, I should have had it mapped out here, but page 11, that's the start of what is your government-wide financial statements. This is kind of a very high-level summary of the city as a whole. So you have your first column there, that's governmental activities, and then you have the business type activities. So the governmental activities is all of the basically it doesn't include water, sewer, solid waste. So that's the government as a whole, not including those funds. And this is full accrual accounting, so you'll see all of your long-term debt, all of your capital assets, all reported here, and you won't see that as you get into the governmental funds. So you look at your financial statements here, and you see on page 12 11. Sorry, under your governmental activities, you have 355 million in total assets. But if you look, the two numbers above it, roughly 285 million is made up of capital assets. This is money that basically you can't spend. Goes down, and then you have down below your net position, and you can kind of see that 262 million is investment in capital assets. So you have a net position of 221 million as a city as a whole in your governmental funds. So how do you read that? Well, 262 million of it is a net investment in capital assets, and then you see this very large negative unrestricted net position.
What page?
I'm sorry, page 11. Yes.
So why are the enterprise funds not included in this?
They actually are included, they're just in the column next to it. So it says business type activities, governmental activities. So The governmental activities is all non-enterprise funds.
Got it, okay.
So you see, you have an unrestricted net position of 83 million. Is that good? Is that bad? Well, it's not great, but it's not uncommon for a government to have a negative unrestricted net position, especially with the pension liabilities. This is all stuff that was just recently added to your financial statements within the last 5 years. So 5 years ago, you back out your $99 million net pension liability and your net OPEB liability. Well, now we have a positive unrestricted net position, but you never really did. You had these liabilities; they were always there. The new accounting standards are now just bringing them onto the face of your financial statements. So, and then the business type activities is actually pretty simple because it's basically an accumulation of the enterprise funds, and there's really no change in the reporting standards. It's all full accrual already, so there's no real changes as you go from the enterprise funds to the business type activities, just the accumulation of those. Governmental fund financial statements, this is where a majority of a lot of the focus takes place. Obviously the general fund, this is going to start on page 14 for those of you following the financial statements. So the governmental fund financial statements are going to include your general fund, special revenue funds, capital projects funds, all of these funds. And then on the face of them, you'll have your general fund, any major funds, and then a total of your non-major funds. The way major funds end up being reported on your financial statements is it's two things. It could be management's discretion. Management might decide, you know what, this fund, we want it to be reported on this as a major fund, or it's a formula. Yes.
Question, is there a digital format with the intact metadata from this file that you're providing?
Can you say that again?
Is there a digital file that we may access with the integral metadata from the documentations you're providing?
There's a PDF.
There's a PDF?
Yeah.
Okay, sure.
Yeah. Is on the city's website. Yeah. Yeah.
Thanks.
So a major fund is presented if it meets a certain threshold. It has to be at least in any category of revenues, expenditures, assets, or liabilities, it has to be at least 10% of the total of the governmental funds, and also 5% of the entire enterprise funds, governmental funds combined. So if any of the categories of assets exceed that percentage, then it has to be reported as a major fund. Couple things to look at that looking at your general fund, what are we doing good? Are we doing bad? Where you want to focus is probably in your fund balance. And comparing it to 1 year to the next. Is our fund balance increasing? Is it decreasing? What are the reasons for it's increasing and decreasing? As well as the income statement, which is on page 16. Looking at that, is our fund balance increasing or decreasing? What are the reasons for that? The unique thing about a government is that it's not a business, especially the general fund. The general fund is not in the business of making money. It's collecting taxes and hopefully going to collect enough to pay for all of the services that are trying to be provided. And in a government, you can look at it from, I kind of look at it from two perspectives. Are we building up a bunch of fund balance? Well, that's great, but are we providing the services to our citizens? So you could look at a city that has a huge fund balance. Well, that's great, but now you have a bunch of money sitting there that you didn't spend and you didn't provide services to your citizens. So there's kind of two ways to look at it. When assessing the fund balance of a general fund specifically, you kind of look at anything that would be considered unrestricted. And even though unassigned is obviously unrestricted, committed could potentially be unrestricted as well. It's been committed by city council through resolutions, things like that. So they've actually committed it for specific purposes, but it's not restricted from outside entities. So when you look at your unrestricted net position, you've got about 13 million, 14 million, which is a little less than 50% of your total expenditures for the year. So that's actually pretty good. The GFOA recommended minimum fund balance is 2 months worth of operating expenditures. So if you look at it from that perspective, you got probably at least 5 months worth of operating expenditures. That's like a GFOA best practice, reserves for your general fund, having unrestricted net fund balance. The rest is kind of self-explanatory as far as you have your special revenue housing fund. The non-major governmental fund is an accumulation from the supplementary information, which begins on page 65? Yeah, 65. So that total non-major fund that you saw on the governmental funds is an accumulation of all of these funds beginning on page 65, which crosses all the way over to page 68. So those totals are brought forward, and that's now just a fund in your financial statements as a total. So this is where you have different special revenue funds. These are funds that are restricted for specific purposes. You have your gas tax fund, home program, several different funds. And they're special revenue funds for the purpose that the money that you receive through gas tax is restricted. It can't be used for anything other than what's required by gas tax. Streets, roads, things like that. It can't be used for any other purpose other than those. Same with all of these other special revenue funds. They all have specific purposes, and typically they're smaller, which is why they're considered non-major.
Good question.
Yes.
If the fund is not used up completely, does that affect does that affect the following year's funding, or are these set in stone? Every year you receive this amount.
Yeah. For instance, gas tax, it would just depend on
Usage, right?
well, your usage is not the amount that the city receives
Right.
depends on how much gas tax is sold, or how much
Right.
purchases, things
So
like
like the
that.
air quality management district?
Air quality management district, I would have to check exactly how sometimes those can be grants
Right.
that are applied for. It's not just a set amount every year. A portion of it could be a set amount, but other portions could be grants. And when you're assessing some of the special revenue funds, if you're bored and you just want to go through some of these non-major funds, if you're looking at a grant fund from one year to the next and the revenues went way down, well, they didn't get a grant. There's a good chance that maybe they didn't apply for a grant, or they didn't get the grant. So these ones fluctuate from year to year. Sometimes in a given year, due to the activity in one of these, it might now become major because they have a huge revenue source that came in for a big project, so now it's being reported as a major fund. One year, following year, it goes back to a non-major fund. So it will fluctuate. One thing I wanted to point out with the governmental funds also, these are considered modified accrual financial statements. So what does that mean? That's basically, it's supposed to be close to cash. So you don't have long-term assets. You don't have capital assets reported in here. You don't have long-term debt. Long-term debt for financial reporting purposes includes claims liabilities, compensated absences, vacation payable, things like that, net pension liability. So you won't see that reported in these governmental funds because of the modified accrual basis that these are required to be reported in. With that, you don't see the capital assets either. And so I know somebody had a question or wanted to find out about, what's the difference between business type accounting and governmental accounting. That's probably one of the bigger differences is when you have an expense for a capital asset in a business, you capitalize it. So you don't actually show an expense, you show an asset. In a governmental fund, you'll have a big expense for an asset that eventually will get capitalized when it goes to the government-wide financial statements. But in here, in the modified accrual, you actually show the expenditure. Same with the repayment of debt. In a fund financial statement, the actual payment for principal is an expense, an expenditure. In a business, if you repay principal, if you're repaying debt, it's just a reduction of the liability as opposed to an actual expense to your business. Any more questions on governmental funds? So then you move to page 18. Oh, sorry, real quick, I'll just kind of brief over this, but pages 15 and 17 are reconciliation pages. These are basically taking your governmental fund financial statements from the modified accrual basis and converting them to the full accrual basis. So it's adding in the capital assets, it's adding in all the debt, it's adding in all of that to then be the entity-wide governmental financial statements. So those reconciliation pages are just showing how it goes from your fund financial statements, which are modified accrual, to your entity-wide financial statements, which are full accrual. Then we get to page 18, which is your proprietary funds. Proprietary funds are made up of enterprise funds and internal service funds. So your enterprise funds are obviously your water, solid waste, sewer funds, and these are also, the internal service funds are recorded in total, so all of the different smaller internal service funds are required to only be reported as one fund in your basic financial statements. Full accrual accounting for both of these, and it includes all of your capital assets, any amounts that have been allocated to these funds for net pension liability, your net OPEB liability, things like that. And then you have income statement for the enterprise funds, internal service funds. If you have any specific questions on those, go ahead. But these are very much they're business type, which means they're very much accounted for like a business. It's a charges based fund, so they have services that they're providing similar to a business where they are compensated for it. So then you have the most enjoyable section of the financial statements, which are the many note disclosures.
Just, excuse me.
Yes.
On that last page, you're looking at page 18.
Yes.
And then in the total column at the end of the page is a negative cash position.
Repeat his question also.
What was the question?
On page 18 in the, I'm sorry, that's the governmental activities. Okay, I just read that column.
Okay.
But the net position, those are, which column tells us the most accurate cash position?
Cash is going to be up at the top in your assets. So the very first line of each of those funds has cash and investments. So you can actually see the cash balance in each fund. And then there's also, some of them have some small restricted cash balances. But so the detail of each is in there, so.
Okay.
All right, back to the fun stuff. So your notes, which makes up a majority of your audited financial statements, is. I'm sorry. Oh. All the note disclosures, as I mentioned before, are required by GASB. GASB issues the statements that are required to be presented, so they're very uniform. If you pick up another financial statement, it will probably look very similar as far as what note disclosures are in your financial statements. They might be in different spots, different note numbers, but overall, these ones that I listed here are probably, you're going to find them in every CAFR you find. GASB takes the stance that a note disclosure is required if it's material. So it goes through all the different accounting policies of the city, how is inventory accounted for, how are capital assets accounted for, pensions, talks about some of your major funds. And so this is kind of just very summary level information about the different categories of your financial statements and how they're accounted for. One of the notes in here will talk about your deferred outflows and deferred inflows of resources. And anybody that has a business or has worked with accounting before knows that it's assets, liabilities equals equity. Well, not in governmental accounting. The GASB invented deferred inflows and deferred outflows. And so that it kind of talks about what these are, but mainly for the city, it's just related to your pension liabilities and your OPEB, and it has to do with the timing of when things are accounted for. So you'll see a big number in there, and it will be a big number for, I believe it's deferred outflows on the governmental activities. And you say, well, what is that? And it's 19 million of deferred outflows. Well, GASB basically invented it, and it's going to be expensed in the future based on future estimates by actuaries. So don't put a whole lot of weight into those numbers for deferred inflows and outflows, because they are based on estimates going forward.
Does that account for future projects or the time it would take to pay for future projects?
So the deferred inflows and outflows on your government-wide financial statements, and let me just double check that real quick so I know what it's on page 12. It has pension-related items. The total is 21 million in deferred outflows for pensions. The note disclosures will give you kind of the detail of it, but basically it has to do with the timing of the pension reporting. So the pensions are accounted for a year in arrears. So, oh, I'm sorry, page 11. I keep screwing that up. So any payments that were made in 2018 towards your pension liability is deferred until the following year, because the liability is actually measured as of 2017. So very confusing, but the reason is because actuaries have to calculate all this information. CAFRs has to do it for hundreds, maybe probably thousands of agencies in the state, and they do it a year. They account for it a year behind so that you have the information ready and available to be used in your financial statements the following year. And it's all GASB 68, which covers this accounting standards, allows for, I believe you can actually do it up to 2 years in arrears, if I'm not mistaken, but CAFRs always does it for 1 year in arrears.
So all deferred expenditures are always going to be in conjunction with like a pension?
These ones, pension-related items, yes, but there are also differences in calculations by actuaries. So an actuary will do an estimate of what they expect the investments for pensions to earn, and they will base decisions based on that. Then the following year, they will reanalyze that and adjust it going forward, and then they defer it, and then they will amortize it over a several-year period. So that number is always changing, but within there is an amount for the contributions that were made in the 2018 fiscal year. Now those amounts were expensed in your fund financial statements. So whatever the city paid for pensions was included in the general fund, any of the other funds. When you go to the full accrual, that's when it gets put into deferred outflow, but then the previous year's comes in as an expense. So it kind of washes out for the most part. I didn't write the standards. I have a feeling if they would have made it a little simpler, it would have been just as much information that you already have. But yes.
Is that pension related? Is that percentage? Does the actuary use a percentage per year
For which, I'm sorry?
for the actuary for the pension related items? The amount, the
So-
totals that you have to set aside, the deferred outflows. Is that?
We'll jump into the notes here because there is an actual note disclosure that provides the detail for this of what that's made up of. Page 49 of your CAFR, kind of the middle of the page, it has deferred outflows of resources and deferred inflows, and so you can see the total 21 million there, which agrees to the financial statement that we're looking at. So you can see the pension contributions subsequent to the measurement date. That's the 7.6 million. That's the amount I was referring to. That's those are the amounts that were paid this year, but will be recognized next year. Sorry. Changes in assumptions. These are changes in assumptions by the actuary. Some of it could be because of the changes in expected life expectancy of retirees, future retirees, things like that. That will have an impact on their estimates, but then they don't want to show that full amount to impact in 1 year, so they amortize it over several years because it's always changing. I know I'm not doing a great job explaining that, but I'm not an actuary either, so it's.
Would it be fair though to think it's percentage increase per year, then, right?
It's not going to be based on a percentage. It's going to be based on changes in mortality rates, changes in investment rates of return compared to actual rates of return based on estimates. There's a whole lot of stuff that goes into those amounts, and it's not a.
That was my understanding that the pension plan is guaranteed a certain return.
Not a return, a payout, a divine benefit.
Defined
They
benefit.
know what they're going to get, and so the actuaries have to figure out how much you have to put in today to get that benefit in the future. So it's a defined benefit plan.
Right.
And so they have to say, okay, you have 300 employees and some are 20, some are 50. The average retirement date is this. They would have paid in for this long, and it's all estimates of a bunch of different things, and they crunch all these numbers to come up with what they say the cost is going to be and how much we need to contribute to meet our debt in those future years, and it's not a percentage.
So CalPERS will estimate it's called the discount rate, what they expect to earn, and it's a long-term rate of return. And currently they have it at 7.15%.
So it's like somehow this percentage is being brought into this.
Right, but that's the expected rate of return on the actual investments that CalPERS is holding. And so from 1 year to the next, they might earn 8.5%, or they might earn 5.5%. And so based on that, from one year to the next, they have to adjust when they determine what your pension liability is. They do it assuming that you're going to earn 7.15%, but you may only earn 6.15%. So now your liability went up, even though you paid what you were supposed to pay. Your liability went up because their investments didn't earn what they were supposed
It
to.
could actually drop to 4%, 3%.
Yeah, if it went down, I mean,
And then
it did several years ago,
And that's what I'm
and
getting at. So then our liability
goes up.
increases.
Yes,
Right.
yeah.
But in the old days, like in 2002, a city that I worked for, that was the tech bubble where earnings were through the roof. The cities in 2002 didn't have to pay anything because they were super funded.
Right.
But then the next year, the market tanked, and the city that I worked for PD, for every $100 a person earned, the city, for their PERS percentage, had to pay $54.50. So that is a huge, especially when their public safety was $75 million a year, that was a ton of money that all of a sudden the city owed. And since then, PERS has learned, and instead of hitting you all at once, they're smoothing. And they're smoothing, so this amortization is, instead of hitting us all at once in 1 year for that 4%, rather than the 7.5% we were expecting, they're allowing us 4 years to make that up. But then if it happens in the other direction, they're not saying, okay, this year you can give us $2 million less because you made $2 million more than we thought. They're going to smooth it to offset the other, because there's multiple items that have to be amortized that they estimated that didn't come to fruition. And so they're smoothing things for us so that we don't get hit all at
So
once.
when I get asked questions that say, if our deferred outflow for pension-related items last year was lower, or is it the same? Was it lower in 2016? Was it lower in 2015? Are we seeing a gradual increase for the city?
Well,
That's a question I get a lot.
for the deferred outflows,
Yeah.
I wouldn't focus on that. I would focus on the actual pension liability. Yes.
Yeah, which brings me to page 48, the very far right column.
Yes.
You've got two types. You've got your miscellaneous plan, and then in the middle you see safety plan.
Yes.
And if you look at the very bottom line on each in the far right corner, we have 40 million and 72 million. Can you explain what those two numbers signify?
Yes. So these are what are considered your net pension liability for miscellaneous and then for safety. And so if you look to your left, 2 columns over, you have what actuary determines is your total pension liability. This is what they have determined that you owe for pensions. Then you have what's considered your fiduciary net position. This is actual assets that are held by CalPERS to pay those benefits. The net is obviously the difference, right? What's left over is you still owe, and this is an actuary saying what your current liability is to pay those benefits for future retirees, current retirees, until they hit the mortality rate, right, where they are no longer collecting benefits. This is what you would owe. It's an estimate. And what I like to point out is if you look on the next page over, page 49, the first table there, this estimate, the 40 million and the roughly 72 million is if CalPERS meets their mark at 7.15% for however long they're expecting to earn these benefits. If they earn 8.15%, if you look just below, you can see where the discount rate has a 1% increase. Your liability goes down millions of dollars. So it goes from 40 million for your miscellaneous to 26 million. And this is just based on a 1% change in their estimate. Same with safety, it goes from 71 million to 48 million. So these are huge differences, and these are huge estimates. If they don't earn, right, what they expect, look what your liability jumps up to. from 40 million to 56 million, from 71 million to 100 million. So it's not a perfect system, right? It's an actuary. They're doing their best to determine what is our liability. The market could go crazy and you could earn 15% and you could be super funded in 5 years, you know, and that happened. But what you're going to see with with your pension liabilities, it's going to go up for the next several years, and your contributions are going to go up for the next several years. There will be a point in time, and I don't know when that is. I know some actuaries have done some work on, well, when is it going to level off with all the changes that they've made in 2013 for PEPRA, which is it was basically the change in new employees and what benefits that they would get through CAFRs, and the benefit has been reduced. So, you know, instead of 3% or 3.5%, they're getting 2% at 62 as opposed to 50 or 55. So at some point, it's gonna level off, but it hasn't, and it probably won't for many years. While it was just implemented 5 years ago, I believe, 2013. And so you guys are not the only city that are having your pension liabilities and also your actual pension contributions increasing significantly from 1 year to the next.
Question.
Yes.
Talking about liability, to like reduce them, perhaps like to get the numbers back up on the board, like for them to make sense. I would say something adequate for the situation. And breaking them down, they're not really broken down. Current trending talks from the municipalities, like negative equity translated to what is liabilities on legal courthouses, not much that, but a bunch of factors that contribute to the government shutdown, which is walking about fraud scheme courthouse, where the city hired doing bad business, they hired not to mention names, principals, all common cases. Liabilities just right now for each one false arrest goes up, and most likely it's each false arrest like 1 million. Computed on equity and all that stuff is going down. It's not really broken down.
I believe you're talking about.
Would you repeat the question?
Yeah, I think he's asking about claims. Are you talking about claims against the city, like claims liabilities? Is that what you're referring
Right.
to?
So for instance, losses brought against the city, they reflect into liabilities. False arrests, they reflect into false. There's nothing here like broken down. And for instance, like a deficit of 850K times 3, so like making numbers make sense and each false arrest for
Is
each
this
false
something
arrest
we can cover
repeats.
after?
What's your question?
Pardon?
Well, let me just. I think he's asking about claims liabilities and why they're not showing up individually in your financial statements. Like what claims, what false arrests, things like that. How that's impacting your financial statements.
Just live an example. Okay, my question is this: if the liabilities are broken down in the report, I'll read this.
Yeah, well, so your liabilities are broken down between different categories: accounts payable, interest payable, vacations payable, long-term debt, things like that, claims payable, and that's going to be broken down in each balance sheet. It's not going to be broken down to indicate who you're paying. That'd be too much detail to report in your financial statements. This is very much.
Fraud by insufficient info.
I'm sorry?
If you say it's too much info, it would be fraud by insufficient information.
Do you say fraud by
Yes, sir.
No. So your financial statements are summary information of your financial
This is
report.
not this is not full breakdown.
This is not a general ledger. This is not a list of checks that are issued.
Where can we find that information?
You have to. Okay. You probably have to contact.
Go through the city clerk.
Yeah.
They have to determine
So
whether
records
information is
request.
confidential or not.
Yeah.
I'm not sure if you can give me
Excuse
some
me, ma'am.
summary of what's driving the increase of the pension plans, because I still don't know even.
What's driving it?
What's driving it again?
The
Root cause.
increase of liabilities and costs. It would be people are living longer. They're not earning the investments that they expected to earn. benefits are benefits are high. If somebody can retire at 50, 55 when they were living till 65, 70, and now they're living till 85, 90, and it's a guaranteed benefit. They were expected to pay it over 15 years, now they're paying triple, what they expected to pay. So as people live longer, it's great, advances in medicine, but it's causing your pension liabilities to go up. That's kind of a summary. Yeah, and if you go from almost any municipality that is part of CAFRs, the benefits are very close to being the same. So years ago, many people or many agencies kind of just adopted the same benefits and they followed the state. So if you want to blame the state. The ones are pretty much self-explanatory as far as the information in them if you go through. Budget versus actual. This is your required supplementary information. This is what it's a part that's required for basic financial reporting, and you are required to show a budget to actual report for your general fund and any major special revenue funds.
Can you direct us to what page?
Oh, it's page 56. So page 56 has your. Did I Okay.
Talk loud.
All right, here we go. Okay. So you have on this page 56, which is the general fund, it's a budget to actual report. You have an actual column. This will tie to your governmental funds page where we were talking about the general fund and major funds. Then it's your original budget, your final budget based on any amendments that were made throughout the year, and then it has the actual amounts, and then it would have the difference and positive, negative variances. So it kind of assesses how did you do compared to what you budgeted.
I have a question on that. I'm noticing that it says property taxes, the variance are negative. So in a time when our property values are actually going up, does that have anything to do with the statement, was it on page 11, about, was it page 11? I can't remember what page it was, that I've read briefly, that talked about how actually the citizens have saved money on the amount of property taxes they paid because of the fire annexation. Is that what's related to this?
So I believe the variance, I think you're talking about the property tax of the 1.2 million variance. This has to do with
page 7, sorry, page 7. Property taxes decreased by 4.2 million or 20.2% from the prior year, primarily due to fire department's annexation to the San Bernardino County Fire District. Is that why we're losing? We thought that the drop?
No, well, the city budgeted for that.
Okay.
So the budget, the city budgeted for the decrease in revenues for the annexation. The difference here, it has to do with the timing of when the city received the county, I believe, took a portion of the RPTTF money that they were not supposed to take.
Oh.
But that's
So-
not in the fund financial statement.
Right, so that's why you have this it's showing that you have you didn't collect as much as you budgeted. I think it was about 1.1 million, something like that. So really, the budgeted to the actual, and it has to do with the timing. So the city didn't actually receive the money until January.
Still haven't.
Oh, you still haven't received it. The county took a portion that they were not supposed to take,
Gotcha.
and they've all since agreed that they were not supposed to take it.
Okay.
So they're going to pay it back. But due to the timing and because of its modified accrual, you haven't received it within 60 days. It's not shown in that number.
Okay.
So They will get it, it's just not in there this year.
So is there any place that you can find the various explanations?
Variance explanations, if they're big, there should be some sort of explanation in the MD&A. But again, it might not be as detailed as you would expect, because it's kind of summary information. And again, a budget is not it's a guess. It's an educated, obviously, best estimate on what they expect to receive. So there won't be anything, and the reason is because
There won't be anything in here. Does the town keep some explanation on the website or anything about it to explain budget variances?
you'd have to ask.
I'm just curious.
Yeah.
No?
Start with the MD&A,
Right. And if it's not in there?
then you can ask and we can do the research.
Okay.
And then you have the housing fund, which is a major special revenue fund. Then you have some of these budget schedules, required supplementary information that has several years worth of different budget pension activity. If you have any questions on that, I can go through it, but it's a lot of detail. Then OPEB as well. OPEB, this is a new schedule this year due to the implementation, and it talks about what your actual costs are, what the total OPEB liability is, how much you guys have set aside for it, and then what your net OPEB liability is. And then, I'm sorry, this is page 62. I don't think this is working. And this is a new schedule this year, so as years go by, this will grow. You'll see more columns, yes.
Okay, I want to go back to budget versus actual.
Okay.
Is there a schedule of budget versus actual on the enterprise funds?
No, for financial reporting, you would not disclose budget to actuals in your financial statements.
Thank you.
On that page, does charges for services, does that include water?
No.
What's in there?
Charges for services would be, I'd have to look at the actual detail of the accounts, but it's charges for services in your financial statements.
In the general fund?
Yeah, the general fund.
It's administrative fees for CFD administration, charges for recreation classes, public works charges,
Yeah.
development services charges.
There's a lot of, all different
Inspection
kinds of fees
fees.
included in there, yeah. But this is just the general fund, so any water, sewer would be not on there.
Quick question, intergovernmental, is that between different municipalities? What is?
Intergovernmental would be, yeah, it could be some grants, yeah, from other government agencies, mainly the state or federal. But I think in this instance, it's probably the state. So earlier we kind of went through the combining statements for the non-major funds. Is where it has all the individual non-major funds listed, and then the totals are brought to be the total non-major fund. This is all supplementary information. In a financial statement, it supplements the basic financial statement. So the detail is back here. The summary is in the governmental fund, total non-major fund column. There's also budget to actuals for each of these non-major funds. If there's a budget adopted. So some small funds might not have a budget adopted because it varies from year to year if you're going to have a grant, if you don't have a grant. So if it does have a budget adopted, it would be there'd be a budget to actual schedule for these. And for for the non-major supplementary information, you're only required to show the final budget and the actual. You don't have to show the original budget. Any questions on those? Internal service funds, beginning on page 91. This is the city has several internal service funds for different purposes. The way these funds work is they kind of operate like a business where they are actually charging the other funds within your financial statements, general fund, water fund, all the various funds for these services. So it kind of operates like a business in that sense. And then this is where it's reported individually. And then if you remember on the proprietary fund statement page, we had the one column which was the total of these internal service funds. These are very, very similar. You know, many cities have an internal service fund for self-insurance, vehicle replacement. Makes it easier to charge the funds to operate activity that all of them are using, as opposed to just allocating it to one fund or another. One of the obviously the biggest, most significant of these is the self-funded insurance fund. This is where it has all of your claims liabilities. These are claims that have been made against the city that have gone through a third-party claims administrator that determines what the expected or potential exposure could be to the city that they might have to pay out. These are also estimates, and so this is a liability that you could potentially have to pay for claims that have been made against the city. It should be noted it also includes what's called an incurred but not reported claims. So there could have been claims that could still be made that occurred prior to the end of June 30, but they weren't actually made as of June 30. And so the city would estimate how much those claims could potentially be and how much they might impact your claims liability. Any questions on those?
Is that claims and judgments payable? Is that the estimated one?
Yeah, claims and judgments payable. So that's an estimate.
But the one above it is actual claims that are payable?
No, so there's a current and then there's a non-current. So the current is what is potentially expected to be paid out within 1 year of the reporting date. So the 2.3 million is an estimate of what they might expect to be paid out this fiscal year, or in the 18-19 fiscal year. And then the other portion is what could be paid out years past that. Any other questions?
So what's the number of that page?
Thank you.
So how do they estimate the non-current liabilities on claims if the claim hasn't come in yet? Is that based on past history, or how do they estimate it?
Typically, but they can actually do it based on actual claims, because at the time they would know what claims they have that relate to that time period. But typically it would be based off previous history. So if they estimate that here's our liability at this given time, we'll probably get 10% of that claimed against us. So it is an estimate. The claims administrators, they use kind of their own tables. So if it's a specific type of claim, they estimate it's going to cost the city $50,000. It might only cost the city $2,000, but they estimate it, and in actuarial accounting and in financial reporting, it's conservative. So you try to be as conservative as possible, so the best case scenario, it's less than that.
terms of establishing the budget, can you describe what the process looks like and how citizens have an opportunity to take part in that discussion in terms of like priorities, et cetera?
Yeah, I would not be the one to ask about that. I'm an auditor, so we focus on the financial statements. Budget, you probably go to the city management. Yeah, there's no negative disclosures, so you don't disclose things that didn't happen. You don't disclose notes that aren't applicable to you. So it's just, yes.
Because Roger explained to the council that he does not, that you don't do the same type of audit for each
agent, yeah, right.
So the audit you did was not, would have been different, it should have been different, and maybe you could do another city, correct? And each year it could be different.
Yeah, well, when you, now we're getting into auditing, but when you approach an audit or you come into an audit, each agency is different. So you have to, you know, do different procedures that you might, you know, one agency might not have a water fund, so you obviously wouldn't be auditing that. The structure of an organization will be different. They might have less people in finance, so there's, you know, one or two people that do a lot more things, so you have to do a lot more testing and focus because of the segregation of duties, things like that. In addition, we have to do what's called a risk assessment, where we assess the risk that the financial statements could be materially misstated due to fraud or errors, things like that. And so that's kind of how we have to approach each line item in your financial statements. Well, how could this be misstated? Well, they have these controls in place. We've done testing of your receivables. We've done testing of your payables, testing of your cash accounts, your liabilities, things like that. So it does vary from agency to agency.
And at the end of your audit, you found no indications of actionable fraud, correct?
Yeah, we didn't. If we did identify fraud, we would be required to report it. Yes.
So nothing was found.
We did not identify fraud.
Okay.
Material to
What
them.
you just described, is that considered a forensic audit? Because I hear different, like your audit, forensic audit.
Yeah, so this is a financial statement audit. So we are auditing the financial statements that management has prepared. So we're auditing the amounts and the disclosures in the financial statements, and part of that we have to assess that they could be materially misstated due to fraud or errors. And so fraud is a huge word that people throw around, but we're not doing a forensic audit. We're not doing a fraud audit or you know, whatever the term might be.
And
We're
it's
doing
routine, it's once a year?
the financial statement audit is done on an annual basis.
Annual
Yes.
basis. Thank you.
Yes.
Given your audit, I know it's only been 1 year, but having done your assessment of the city and how it's run, how would you say our financial health is? And whatever information that you're available in terms of how our prospectus looks going forward?
Yes, as far as financial health, I think that would be probably more up to management and also council to assess, you know, are we where we want to be, you know, are we heading in the right direction? We don't do prospectus, so we don't do a whole lot of looking forward unless there would be, you know, significant concerns that, you know, next year wouldn't, you know, be good. But, you know, just looking at, we will evaluate, you know, what does your fund balance look like? Does it, you know, are you able to pay your bills? Are you able to, do you have a fund balance available? So if these were significant concerns that we had as we looked at that, we would have brought it and reported it to City Council.
More specifically, do we have the minimum reserves? I believe there's a standard, some sort of threshold that we should, you know, achieve to just make sure we have.
That the city has established a minimum
Yeah,
threshold?
sort of a
Yeah,
reserve in
yeah, I
place.
think.
Do we need that?
Yeah, you guys have met that reserve. Yeah.
We exceeded it, actually.
Yeah,
Right,
exceeded.
so it's not-
We're like 24.1, when it's required 12.8,
What's the minimum, by the way?
12.8,
So the minimum you're referring to is what council has established through ordinances or resolutions for what they have decided to be their minimum. In the auditing world, you know, as far as what we're auditing, there's not a minimum, you have to have this. So that's not really, for us to say what the minimum is. The minimum would be whatever your council has chosen to be.
And as a guideline, we mentioned best practices.
Yeah, best practices.
Right, so best practices was,
Yeah, and
say 3 months?
yeah, best practices, that's the GFOA's best practices would be 2 months reserves in your general fund. They don't really go into all the other funds, but, so you kind of have to assess the fiscal health.
And we had 5, you said 5
5 what?
months.
Yeah, just, on first glance, you have about 14 million in unrestricted fund balance.
Part of the dubious number, isn't it? Just 14.
Seems to be seen.
Yes.
During the CAFR audit, you brought up that there was a $1.1 million error that the county pulled out. During this, would that have been caught normally?
During the audit?
Yeah, during the CAFR, would your firm have seen or had access to knowing that the city got ripped off by the county by $1.1 million, or would that have gone unnoticed?
Yeah, so we actually get reports from the county from what they actually paid you guys, paid the city. So we will verify that if the city says that they paid, or the county paid this amount, we verify that that's what the city has recorded, so we confirm those. They didn't actually pay it, so they didn't get it. We don't actually test that the county is doing their calculations correctly to, pay the city the appropriate property taxes. I don't know any auditors that would actually do that. The county's auditors would be actually, testing that, but the city actually identified that they did not get that money because they had been expecting to get it and they didn't receive it.
So that would potentially would not have been caught through your process, through the CAFR. It was done internally through the city.
Yes, that was intended.
It could have been in the way that, like, a budget.
Yeah, the budget to actual, that would have been a way where we
They
would have
said,
said,
hey, why is this variance so big? And that would be a key to them, that something, give us an explanation. And we would dig into it and say, this is what we found. We should have got this from the county and they didn't give it to us. So there was potential.
yeah,
if
management was already aware of it
Yeah.
when we came out to do our audit.
And what was they took they didn't pay 1.1. What was the number that was supposed to be paid?
The 1.1. Yeah.
See, what happened with the county was, there was a negotiation for a specific percentage, but I wasn't there, so I don't know, but I'm assuming there weren't particulars. And they just said, here's your secured ad valorem property tax. Here, ad valorem property tax. So that number times the percentage gives us the money that the county needs to keep. But then they took that percentage and they applied it to our trailer coach license fees, our redevelopment redistribution. They applied it to everything across the board. And that wasn't our agreement. Our agreement was this percent of this item, but how their system sets up, it doesn't take this percent of this one, it takes this percent of everything. But that wasn't our agreement. So we started in like April or May determining that this happened, and it took until December for the county to go to their board and approve, or the fire district to approve the fact that we need to change the percentage, because if you're gonna hit it across the board, then you need to lower the percentage, because we agreed on this dollar amount, and you took that dollar amount plus. So they approved it in December, and then our council had to approve the special tax exchange, and now we're waiting for the money.
And this was all based on the fire department, the Upland Fire Department being given away, correct? When the
It was
change was made.
negotiation as part of the LAFCO process.
Thank you.
Any other questions? I've also passed passed out some survey forms, so if you could please fill them out and leave them at the back, we'd love to hear your feedback. Our workshops can only get better with your input, so thank you for that in advance. And if you signed in when you got here, we have your email address if you opted in. We'll notify you of future workshops as well. Thank you so much for coming and for caring about the city of Upland. We hope to see you on March 20th when we talk about the brown ones. Thank you.
Thank you.